Hello and welcome to this overview of the Series 7 exam brought to you by Passing Score, where you can get more help on your exam prep at PassingScoreFinance.com. In this video, we'll be going over the last of our Series 7 overviews, which will focus on taxes. Let's go over some definitions. Progressive tax is one in which the tax rate increases or the percent that you pay increases as your income rises. And a regressive tax is where the percent of your tax decreases as your income rises. There's also earned income, which are things like salary or running a business, things where you're actively taking a part in earning the income, and this is taxed as ordinary income. And then there's passive income, which are things like rental income, dividend payments, or interest income. And if you have losses in these areas, you can only offset those against other passive gains. And then there's deferred income, which is when you don't have to pay the tax until you withdraw or sell the asset that you've had the gain on. There's different types of tax policies depending on who's issuing the bond and at what level, the federal or the state. So US federal government bonds are taxed at the federal level but not at the state level, while munis, which are issued by local governments, are usually not taxed at the state level and aren't taxed at the federal level. And US territories are not taxed at federal or state levels. But corporate bonds, bonds issued by private industry, are taxed at both the federal and state level as far as their interest payments. Some municipal bonds, local government issuances, are made for the benefit of to encourage industry and are not don't qualify for tax exemption. So they may be subject to federal and state taxation, as well as the AMT or the alternative minimum tax. There's a special rule for corporate dividends. If a corporation buys the shares of another corporation, any dividends they received are 70% are excluded from being included in the taxable income. There's certain rules around that. You have to own less than 20% of the other corporation, and 80% of the dividend is excluded for ownership over 20 when you do own over 20%. And mutual funds and REITs as the investment vehicle do not qualify. Other types of dividends can be from foreign securities, in which any foreign tax can be netted out against taxes you have to pay in the US, and stocks, dividends, and splits, which don't affect the dividend gains, but they do change your cost basis on a per share basis. Capital gains are a very important feature for securities ownership. This happens anytime you sell the asset for more or less than the cost basis. So you can have a capital gain or a capital loss. And losses can offset gains and ordinary income up to $3,000. But let's say you have a loss of more than that. Those can be taken in future years up to the maximum in every year. So if you have a loss of $7,000, it may take you up to 4 years of the offsetting ordinary income before you go through it. Short-term gains are taxed as ordinary income, which is usually much higher than the 15% that you pay when on the tax for a long-term gain. Capital gains are also paid on short sales, but they're treated as a short-term gain no matter how long you have the short sale position. And just recently, there's been an addition of a 3.8% tax on net investment income if you exceed certain income levels. Also, you can choose which shares, if you have a pool of stock and you sell a portion of it, which ones at which price you bought uh, uh, to calculate the gain or the loss. If you don't specify, the IRS will assume that you're doing it on a first in, first out basis, meaning the first shares you bought, that price will be used for the capital gain calculation. The cost basis is used to calculate how much tax you're going to have to pay. So if your sale price minus the cost basis is going to determine your gain. So a very important area. On convertible securities, it's going to be the original cost divided into the new security. So you're just going to chop up whatever you paid into the new units that you've converted into. If you inherit some securities, first, congratulations. And also, you're going to have to pay tax as of the market value of the securities at the time of whoever's granting you the shares, at the time of their death, at the time of the benefactor's death. That's going to be your new cost basis. So this will help you avoid paying tax actually on any gains that have run up before then. And inherited securities are treated as long term no matter how long they were held before that. And then gifted securities are the lower of the market value or the cost basis of the person that was giving it to you. There's also gift taxes. So you pay a tax on anything that's gifted over $14,000. Now, if you're a joint filer, you can get that up to $28,000 of gifts up to somebody. And this includes securities, real estate, or any other valuables that you gift to someone. There's also estate taxes. So after you pass away, there's going to be a tax on your remaining property. But the first $5 million is exempt from any tax, and it'll continue to rise over the years tied to inflation. Anything over the $5 million will be subject to a 40% tax. And there can be other state taxes as well. This is just at the federal level. Now, munis can be bought at a premium or discount or at par, and that will change how you calculate your tax. If you purchased your muni at par, anything that you sell above will be a capital gain, and anything that you sell below will be a capital loss. If you buy your muni at a discount, it gets a little bit more complicated. So if you bought at 97 and the par is going to be always 100, the 3 will be taxed as ordinary income at maturity. So the discounted amount, the 3. Anything above that will be taxed as a capital gain. And there's a difference between if you let it mature or if you actually sell the security at higher than that amount. If you buy your muni at a premium, that premium is amortized over the life of the bond, so you're getting back down to the par level. And if you sell above your cost basis or below the cost basis, it's going to determine whether you have the capital gain or loss. For treasuries and corporates, we have a lot of discounted bonds. And these are, again, accreted using the constant or level yield method, which is a little bit of a complicated calculation. And you pay your tax on the annual accretion rate. There's also accrued interest on amounts that don't actually pay the interest out annually. So you earn the interest, but you don't actually receive the cash. So if you're buying or selling the security, the seller is going to have to pay the tax on anything that was accrued up to the selling date, and then the buyer is going to subtract that accrued interest from their bond payment. There's also different tricks that people try to do, such as selling a security to try to claim a loss and offset some gain, and then buying the security right back again, so that they basically have the same position, but they've been able to lower their taxes. In order to avoid this, the IRS has something called a 30-day wash rule. You can't claim a capital loss if your position really hasn't changed within 30 days. So if you claim that loss on the sale and buy the stock back again, it's considered that you didn't really sell it since your position is, as they say in the rule, substantially the same. So this is a rule to avoid kind of manipulation to lower your taxes. If you have a call option buyer or seller or the different things you can do with options, the way you calculate your taxes, your cost basis, and your gains depends on what position you're in as a buyer or a seller, and if it's a call or a put. So we'll go through those quickly. Your cost basis, if you're a buyer of a call option, is the strike price that you're going to execute at, plus any premiums that you paid. So this is what you're laying out for the call option. So your gain or the loss is the sale proceeds, what you get, less that amount that you paid, the strike and the premium. If you're the writer of the call option, you're receiving the premiums and also you're receiving the strike price if it gets exercised. So your gain or loss will be any sale proceeds, uh, the total of those, strike and premium, less the purchase price. For a put option buyer, remember, they're buying this option in order to sell the security. So they want the price of the stock to go down. Their sale proceeds are the strike price less any premium that they paid up front. So their gain or loss is the sale proceeds less the purchase price. And for the put option writer, they're actually receiving the premium, but they're at risk of losing money as the price of the stock goes down. If it goes up, they just get to keep their premium. So we have a cost basis of the strike less the premium, and their gain or loss will be their sale proceeds less that cost basis. That's it for our overview of the tax section. If you have any questions, please feel free to email me at john@passingscorefinance.com, and good luck on your exam.